Guys, we have 3 stocks trading at or near their 52-week low, and I love looking at 52-week low stocks, and I want you to be the same. And the reason being is, in order to find value, it's important to find stocks that are cheap. And the easiest way to get cheap is stock falling. So it logically dictates that stocks that are at or near their 52-week low are cheaper than when they were at their 52-week high. Now, just because a stock is down does not mean it's cheap, but it's a great place to start. Stock number 1, the company of all companies, well, not really, but Johnson & Johnson. And in-house here, one of our employees here hates looking at Johnson & Johnson and hates using their products because he hates the Jets so much, and he refuses to accept the fact that a member of the Johnson family owns the Jets. So Johnson & Johnson's at 147.11, but interestingly enough, 52-week high was just 3 months ago at 168. Very tight range here. This is pretty tight for most 52-week highs and lows. And you look at the last 5 years in this chart, I mean, guys, this is not a very volatile company. Now, if you look, a big chunk of the returns that have come from Johnson & Johnson over the last few years, look at this dividend, 3.3%. It eats up $11.7 billion of their free cash flow. Now, the good news is their free cash flow in the last 5 years has averaged $18.65 billion, and in the last year, $19 billion. So they can afford that free cash flow. But this company is not going to be a big grower. I want to show you that based on analyst estimates here, going to revenue. If you look right here, revenue growth potential for this company, according to analysts, 3, 4, 5%. And guys, it makes sense. It's so big. They sell everything. How's that really going to grow a ton? It's going to be hard to add to that bottom line or add to that revenue number. Now, one thing I love about Johnson & Johnson, 12.5% return on invested capital in the last 5 years, 13.3% in the last year, 21% return on equity. Now, these metrics say, hey, we get a good return on the money that's invested in the business. This is a good thing, and it looks like it's getting better. But to look at some other metrics, let's go check out the 8 pillars and what the story is in this company. All right, so we have 7 out of 8 checks. Now, here's what's interesting. This is what I say when I always talk about 8-pillar investing. The 8 pillars tell the story. I have 7 check marks here and some random X on net income growth, but yet we have cash flow growth. Net income fall, cash flow growth on $6 billion revenue increase. I look at this saying, there's probably some random reason for this, because you look at their free cash flow last year of $19 billion versus their net income of $14.7. My guess is they had a write-off here. So what we do is we go to our income statement, look in the last 12 months, and let's see. Look at this, guys. We have special income and charges way higher than before. Way higher than before. Other income and expenses way higher than before. So it's explained away. They probably wrote down something. And if you want to find out what it is, their 10K, which you can access very easily on the main page, just click this annual reports button here. It takes you right to the SEC page and right to the Johnson & Johnson 10K. It'll tell you exactly what that write-off was. But to look at their other pillars, they're selling for 17 times 5-year earnings, 19 times 5-year cash flow. Is that a lot? Well, in this market right now, it's not a lot. Historically, maybe it's a little high. I don't know, because this is a company that's probably going to be around for a very, very long period of time. Dividend lovers will love the fact that Johnson & Johnson as a company has increased its dividend 61 years in a row. Johnson & Johnson products are used by over 1 billion people daily across 175 countries. Johnson & Johnson is diversified across healthcare, with their top 2 drugs in immunology accounting for $15 billion in annual sales, their top 2 oncology drugs accounting for $19 billion, and their simple over-the-counter items such as Tylenol, which by itself did $9 billion in sales in the last 12 months. So now going back to analyst estimates, we saw their revenue growth increase, and this is their earnings per share increase. Slightly better than revenue growth, and that makes sense for a company like this. As revenue grows, more is going to go to the bottom line, so they're probably going to grow their earnings per share faster. And as this company gets cheap, I'm hoping they start to initiate some sort of stock repurchase that is much bigger than what they've done. Because if you saw in the 8 pillars, they've bought back about 9% of their shares in the last 5 years. Not bad, not a lot, which I'm glad if the stock has been high. But I look at this saying a great way to add value for Johnson & Johnson investors is, let's say the stock fell in half. guys, cancel that dividend and buy back the F out of their shares. That would be very, very valuable. Now, the question becomes, what is this stock worth? This is why we use our stock analyzer tool. Guys, this is the most popular tool on our website. And the reason being is it allows our users to sit there and put in their estimates for the future. What's the revenue growth? What's the profit margin going to be? What multiple are you going to sell for? And most importantly, what is your desired return? Because every investment is a present value of all future cash flow. This allows you to estimate that cash flow and then put in and say, analyze, and tells you without looking at the balance sheet, this is what the company is worth to us today. This is exactly why it's used over 1 million times per year by our users. So here are the assumptions I've made over the next 10 years, and you can analyze up to 20 years in this thing. I did 2, 3, and 4% revenue growth. Might be a little low. Profit margin, I did 19, 22, and 24. 19, 22, and 24 for free cash flow as well. Now PE, current PE is 24, current price of free cash flow is 19. I put in 16, 19, and 22 because guys, this company is going to be around for a long time and they have Tylenol. They have a lot of great products that are ingrained in our lives that we probably don't even realize we use every single day. 1 billion people use it every single day. I figure that's worth a premium. How much of a premium? I bet you some could argue much higher than this. Now, finally, for a desired return, I put in 9%. Now, guys, the market returns on average are 9 or 10%. So this is zero margin of safety. If you're going to buy an individual company, you need to put in a higher return than 9%, in my opinion. So we hit the analyze button. The stock's currently at 147. And our current levels are a low price of 101, high price of 180, middle price of 140. I have my watch list at 140. Not because I'm going to buy it at 140, but I'm going to start taking a look at it and sell puts at lower prices. And guys, these returns include that 3.5% dividend. So don't think it's this price plus the dividend because this is a cash flow return. Stock number 2, Canadian National Railway. Last 5 years, only up 14.5%. Another one with a pretty decent dividend, 2.27%, that they can probably afford. Eats up $1.5 billion of their $2.5 billion in free cash flow. Not a return on invested capital that we're writing home about, but a great return on equity of 28%. Guys, this company is another one that's in a very tight range here. What I'm interested about here is this gross profit margin of 41.5%, but yet a bottom line of 30%. That's pretty impressive. Now, here's the interesting stuff about Canadian National Railway. They transport 300 million tons of goods annually across its 18,800-mile network of track. They transport 27% of Canada's national railroad shipments. And CNI is the only North American railway with a network connecting 3 coasts, Atlantic, Pacific, and the Gulf of Mexico. The fact they can reach all 3 of those oceans and gulfs and everything gives them unparalleled reach and makes it an essential artery for trade and a strategic leader in the railway industry. You guys all know, good old Warren Buffett loves railway. Why? Railway is the most cost-effective way to transport goods. Is it slow? It is slow as molasses. But the cost to transport goods via railway is unparalleled versus airplane, truck, any of those other methods. It is so cost efficient. So let's go see this 8 pillars and see what's going on over here. All right. So we have a big difference, which I don't like, between the 5-year PE and the 5-year price of free cash flow. And we see that here. You see free cash flow at $2.5 billion and net income at $3.8 billion. Railway seems to be a highly capital intensive business, which means it needs a lot of capital improvements and capital expenditures to maintain. You got to focus on the free cash flow here. You got to focus on this price of free cash flow. I'm not looking so much at the net income, okay? And there's a lot of debt here. I'm not as worried about the debt because it's not like somebody can just go in there and just go say, hey, I'm going to lay track right here and I'm a new competitor to CNI. It doesn't work that way. So I'm okay paying a little bit more of a premium on the company relative to the debt. Now, that doesn't mean you have to be. But again, this approach of looking at it saying not all debt is the same. And with a company like this, having a higher amount of debt, I think there's a lot of value to those train tracks, and I'm okay. Those 18,800 miles of train tracks might be okay and understandable here. So Now, we obviously go to our analyst estimates, see what analysts are predicting here. Almost doubling their EPS, 522 to 989. So some pretty big growth. My guess is as the world economy gets better, as Canada, North America, as Canada, United States, and Mexico's economy do better, they're probably going to do better as well. Now, here's their revenue growth according to analysts. 4, 5, 6%, somewhere in the mid single digits. All right. So let's go to Stock Analyzer tool and see if I've done this company in the past. CNI. Have I ever done it? I've never done it. So I'm going to put some inputs in right now and then explain it. So here's what I did for our Stock Analyzer assumptions for revenue growth. I did 2.5%, 4%, 5.5% revenue growth. For profit margin, I really ignored it. I just put 30% in, but as you saw before, I'm really focused on the free cash flow, to which I did 19, 20.5, and 22%. For PE, again, don't really care, 15, 18, 21. The price to free cash flow is really my important one, and I kept the 15, 18, and 21. Why? Because even though this ROIC is not very high, it's going to be very, very difficult to sit there and get rid of CNI. Those railways will be used by somebody, and they seem to have a pretty good and solid control of that market. Now, guys, if you look at the software, you may have noticed that we have a waiting list to enter our software community. Today's software includes everything we have to offer in stocks, retirement, and real estate. All of these up here. But behind the scenes, we're making changes. So that offer is going to go away very soon. If you've been watching our channel for years, you probably remember that I built this software for myself so that my team and I could use it continually to help me make better and more suitable investments in stocks and real estate and make the right decisions for my future self in retirement. But as time went on in our videos, people would always say, how do I get that software? How did I get that software? So it got us to create the software for everybody else. But as we've grown, it's become less about me and more about how I can better serve you. And this is why we update our software. This is exactly why we have several developers full-time on staff to give you exactly what you need. Now, the good news is we haven't made these changes yet because they're constantly being worked on by our developers. So if you join today, you'll be grandfathered in for life with all of these tools. And guys, this is the best deal we've ever offered. I'm telling you this now because there's still time for you to sign up. As long as you join the Everything Money community and software before we make the changes, you can keep your plan. And more importantly, you'll be locked into your pricing tier forever. So click on the link in the description below to get access to everything we have to offer, including all of our investing tools and community. I assure you it'll be the best investing decision you've made all year. Sign up, $7 for 7 days to try it out. Now, we have the stock currently sitting at $103 per share. We hit the analyze button, boom. Remember, we're focusing on free cash flow here. So we have a low price of 54, high price of 96, a middle price of 72. This includes the dividend. So for my opinion, I'm just going to wait a little bit. I've got to wait a little bit longer for this to be interesting to me. But you might have better insights into this industry than I do. That's what's so great about investing. You have to sit there and figure out what's right for you and what makes the most sense to you. Stock number 3, a big company that I used to own that I got luckier than luck on this one, Walgreens. This company is down 83% in the last 5 years. In the last 10 years, it's down 86%. Walgreens is at $8.6 billion market cap with a $76 billion enterprise value. Guys, I was so wrong on this company. And the second I started to care a lot about return on invested capital, I said, I'm out on Walgreens. And by the way, keep in mind, I love shopping at Walgreens. I think Walgreens is the best corner drug store experience out there. But just because I love a company does not mean the company is a good investment. This is something I want everybody to remember. This is one of our principle-driven investing ideas. Just because you love a company doesn't make it a good investment. It's not just about buying good things. It's about buying good things well. That means at a good price. If you're not doing that, you're a speculator, not an investor. And that's the first foundational principle of principle-driven investing. We are investors, not speculators. And this is a prime example for a company like Walgreens. I think they operate their drug stores beautifully well. Whenever we go overseas, Boots Alliance, the stores, I love them. They're great. But again, you have to pay the right price. Now, with Walgreens here, I think you look at this dividend yield, and a lot of people might get sucked into this dividend yield, 14.6%. It's getting chopped next year. But guys, this free cash flow is struggling here. Now, it recently popped because private equity groups have come out saying they're going to look at deals about taking Walgreens private. I think it's a good idea. This company needs to restructure and rebalance, get back to what they do well, restructure this debt. And the reason being is this company is probably struggling right now with this whole perception. The stock is down a ton. How do we handle it? Don't worry about that. Go back, go private, focus on turning this thing around, and then come public back later when the business is a lot better. There could be a play there. That's probably being played out here. Internally, as we look at this company, we feel like maybe the stock is selling for what would be equivalent to bankruptcy in the sense of, is this thing going bankrupt? But I don't think that's the case here. If you look at the 8 pillars, look at how ugly this is. Everything is just an X. Doesn't mean you don't buy it. Just means there's a lot of things going on here. Every single thing here is terrible. Funny thing is, look at this revenue growth, $27.6 billion in the last 5 years. Net income's down $9 billion. Free cash flow is down $4.5 billion. It's terrible. How do you pay the stupid dividend when you have negative free cash flow last year? It's unbelievable. So this is a company that just has to regroup, restructure everything. Even though Walgreens has had a tough couple years, its healthcare acquisitions are performing with VillageMD growing 7% in the most recent quarter and Shields Health Solutions growing nearly 30% in the most recent filings. They're navigating these challenges with these strategic moves and promising momentum. Let's see what analysts are saying about this. I mean, they have things getting better after a while. From 288 down to 149, which is basically in half, then back up to 426. But who knows if that happens? And the interesting part is revenue growth every single year. Look at this, every single year. And you'll see by our stock analyzer tool that I'm sure this thing is selling for quite the price. And for me, the reason I sold it is when I saw that low return on invested capital, I realized it didn't fit my criteria of companies I want to own for the long haul. And I got super lucky. There was no attempt to sit there and say I knew what I was doing when I sold it, that it was going to fall 60% from there. Not at all. I just got lucky. So let's pull up the Walgreens. Let's look at the last time I did it back on July 11th. So guys, look what I did here. I did -2, 0, and 2 for revenue. Profit margin, I did 1.75, 2.25, 2.75. And for free cash flow, I did 2.5, 3, and 3.5 because they consistently have more free cash flow than net income. So I put a higher free cash flow in. For PE, I put 10, 12.5, and 15, and a 9% return. Guys, look at this. Analyze button. This is what I mean. If I knew Walgreens was going to be around and do these numbers forever, I mean, this is insane returns. The question is it worth putting a lot of capital into it? I don't know for me because it doesn't fit my criteria, and I'd always be worried having to check on this company. So again, guys, Walgreens looks attractive based on these numbers here, and I've found so many great stocks when I look at 52-week lows. I have 3 more stocks to analyze with you that were trading near their 52 weeks low previously. Watch it right here. Thank you for your time.